Are you ready to uncover a shocking prediction that could change your financial future forever? Lynette Zang, the chief market analyst for ITM Trading and a renowned expert in the field, has made an explosive claim about the future of gold and silver. She has a remarkable track record when it comes to predicting market trends, and her latest revelation is sending shockwaves throughout the financial industry. In this video, she will share her insight on why she believes gold and silver are primed for an explosive surge like never before. In this video, we'll dive deep into her analysis and discover why she believes gold and silver are on the verge of an explosive surge. Get ready to learn how you can position yourself to capitalize on this unprecedented opportunity in the precious metals market. So let's get into it. Lynette Zang's analysis of a purchasing power of the consumer dollar based on Federal Reserve data reveals a troubling trend that cannot be ignored. According to her findings, since 1970, the consumer dollar has lost an astonishing 97% of its value. This massive depreciation is a clear indication of the erosion of purchasing power over the years. As a result, the average individual's ability to buy goods and services with the same amount of money has significantly diminished. The transition away from the gold-backed standard is a pivotal point in understanding the erosion of purchasing power. In the past, currencies were tied to physical gold reserves, which provided a natural limitation on the creation of new money. However, as countries moved away from this standard and adopted fiat currencies, the direct link to tangible assets was severed. This change enabled central banks to print money without any physical backing, leading to a substantial increase in the money supply. The subsequent inflationary pressures have been eroding the value of money and causing a loss of purchasing power over time. Negative interest rates represent a significant concern in the erosion of purchasing power. When central banks implement negative interest rates, they essentially charge individuals for keeping their money in banks. Instead of earning interest on their savings, savers have to pay banks to hold their funds. The strategy aims to force people to spend or invest their money, as keeping it in the bank becomes less attractive. Negative interest rates serve as a drastic measure when traditional monetary policies fail to stimulate the economy. However, they can have detrimental effects on savers and investors, further impacting their purchasing power and financial stability. Lynette Zang highlights the consequences of quantitative easing and expresses concerns about the role of central banks in creating inflation. According to her analysis, QE is a monetary policy tool employed by central banks to inject money into the economy by purchasing government bonds and other financial assets. While this measure is intended to stimulate economic growth and boost lending, Lynette believes that it has resulted in significant unintended consequences. For instance, in the United States, the money supply has surged over by 30% since the onset of the pandemic. As a consequence of this monetary expansion, the purchasing power of the consumer dollar has steadily eroded, negatively impacting the average person's ability to maintain their living standard. Lynette Zang points out that the effects of QE go beyond just stimulating economic growth. As central banks continue to create money and inject it into the financial system, asset prices have been artificially inflated, leading to potentially bubbles in various markets. For instance, total global debt has reached a staggering $277 trillion, representing a substantial increase from previous years. This mounting debt burden creates systemic risks as individuals, corporations, and governments become vulnerable to any fluctuations in interest rates or economic downturns. In addition, the injection of liquidity into the economy has not always trickled down to the real economy, leading to wealth inequality and a disproportionate benefit of certain segments of the population. Moreover, the reliance on QE as a primary tool to manage the economy has left central banks with limited ammunition. One of the key concerns Lynette raises is the exponential increase in the money supply through QE, which can lead to high inflation rates over time. With more money circulating in the economy, the purchasing power of the currency diminishes, leading to higher prices for goods and services. Inflation erodes the value of savings and wages, making it harder for individuals and families to maintain their standard of living. Lynette emphasizes that this constant inflationary pressure not only affects people's ability to afford basic necessities, but also undermines the long-term stability of the economic system. Lynette Zang's prediction about the potential explosion in the value of gold and silver becomes even more relevant when considering the risks of relying on an inflationary economic system. In such a system, the value of the fiat currencies is constantly being eroded, making it essential for individuals to find ways to protect their wealth. For example, over the past 20 years, gold has seen an average annual return of around 9%, while the US dollar's purchasing power has declined significantly during the same period. Recent changes in gold allocations by central banks highlight a notable shift towards viewing gold as a safe haven asset. Over the last 3 years, 42% of central banks have increased their gold holdings, demonstrating a growing recognition of gold's role as a reliable store of value during uncertain economic times. Additionally, 51% of central banks have maintained the same amount of gold holdings, while 7% of gold sold off some of their gold. The pandemic served as a turning point for some central banks as they utilized their gold reserves to stabilize their country's economies. The historical use of gold for trading and generating income has been well documented. Around 8 to 10 years ago, central banks increased their exposure to gold and held it in London, using it for swaps to enhance yield. This involved using gold as collateral in trades and transactions with the Bank of England, which provided opportunities for generating income. However, given the recent economic uncertainties, central banks have taken a cautious approach and transferred their gold reserves back to their own countries to ensure their safety. Gold's role as a safe haven asset has been particularly crucial in recent years. Its limited supply and historical stability have made it an attractive choice for investors seeking to protect their wealth from inflation and currency devaluation. As central banks increasingly view gold as a safe haven, individual investors are also considering its potential benefits. Understanding and preparing for Social Security depletion is crucial as the program heavily relies on payroll taxes as its primary funding structure. Currently, 91% of Social Security is funded through payroll taxes, wherein workers contribute a portion of their income. Now, this money is used to provide benefits to retirees and beneficiaries. However, the ratio of workers to beneficiaries has been steadily declining over the years. In the 1950s, there were about 16 workers per Social Security beneficiary, but today this ratio has decreased to approximately 2.8 workers per beneficiary. This demographic shift raises concerns about the sustainability of the program. The declining ratio of workers to beneficiaries has significant implications for the future funding of Social Security. As the number of retirees increases and the workforce growth slows down, the strain on the Social Security system intensifies. According to projections, the Social Security trust funds are expected to be depleted by 2034. When this happens, the program would only be able to pay around 78% of the promised benefits. Lynette Zang's concerns about the potential depletion of Social Security trust funds in 2034 are rooted in official estimates and projections. As the trust funds approach depletion, there is a need for individuals to take proactive measures and plan for their financial future. Lynette emphasizes proactive measures as well and the importance of diversifying investment portfolios to protect against economic uncertainties. These precious metals can be considered as a potential hedge against currency devaluation and inflation. The potential depletion of Social Security trust funds calls for a more comprehensive approach to personal financial planning. It becomes crucial for individuals to explore other sources of retirement income, such as individual retirement accounts, plans, and other investments. By diversifying their financial approach, individuals can create a more secure financial future, reducing reliance solely on Social Security benefits. Additionally, considering long-term care insurance and health savings accounts can offer protection against potential healthcare expenses during retirement. Taking control of your financial future is of utmost importance, especially in light of Lynette Zang's shocking prediction about the potential explosion of gold and silver. Empower yourself by diversifying your investment portfolio with precious metals like gold and silver. As Lynette Zang suggests, these tangible assets have historically acted as safe havens during times of economic uncertainty. Gold and silver tend to retain their value and even appreciate during periods of uncertainty and also of the currency devaluation and inflation. By adding these precious metals to your investment mix, you can create a strong hedge against economic turbulence and protect your wealth from potential devaluation. If you enjoyed this video, guys, make sure to subscribe to the channel, like the video, and watch this one as well.